Hello everyone, I hope you guys are doing well and studies are going in full swing. Now in today's video, we are going to do a complete revision of Ind AS 105 along with all the important questions. So over here, what is covered under Ind AS 105? Well, there are three specific items. First is non-current assets, which are held for sale. Second, disposal groups, again which are held for sale. And third is discontinued operations. So these are the three items. Before we proceed further, we need to understand what each of them mean. As you would be aware, a non-current asset is defined as every asset which is other than current asset. Usually those assets which have a tenure of greater than 12 months or operating cycle, as the case may be. Secondly, you have something called as a disposal group. Now, disposal group is a group of assets or even liabilities which you intend to dispose of as a part of a single transaction. So, this is a group of assets. Like, for example, if I have 10 classrooms and I want to dispose one of them, that is a group of assets. Within that, you'll have furniture, building, air conditioners, all of that together I'm disposing of. And that is a disposal group. And third is a discontinued operation. Now, a discontinued operation has a component of an entity. So, this is like a division of an entity which has either been disposed of, that is, it has been sold off already, so that's a past event, or it has been abandoned. It's not held for sale, it is abandoned. Like, for example, I have a division in Ukraine and there's a big war. I don't want to sell it to anyone. I've just abandoned it. And as a result, an abandonment can also be taken over here if it is over a component of an entity. And third is if this discontinued operation is held for sale. Like, for example, I have three businesses. Let us say one is a coaching business, one is restaurant business, one is, let's say, a practice. I don't have them, but let us say, in which case I decide to discontinue my restaurant business. In which case over here, if I have 5 restaurants and I want to sell all 5 of them, that is a discontinued operation. It has to be a component of an entity which is intended to be sold, or it has been sold, or it has been abandoned. Now, the idea of showing something as a discontinued operation separately is largely to give a breakup in the P&L of how much is the profit which was earned or EPS pertaining to a discontinued operation. However, the idea of showing something as a non-current asset or a disposal group which is held for sale is largely to ensure that you do a proper accounting, like items like PP, intangibles, investment property, goodwill, for example. All of these items are shown as per the respective standards, Ind AS 16, 38, 40, etc. However, in most of these standards, you don't compare it with the market value because you don't intend to sell them. Well, earlier, you never intended to sell them. But now, if they are intended to be sold, then it makes sense to compare it with their fair value and then put a write-off if required. Further, you keep on depreciating the asset considering that you are going to use the asset. However, if you want to sell the asset like an inventory, do you depreciate the inventory? The answer is no. And hence, ideally, if you want to sell the asset, we should not necessarily go ahead and do the depreciation. But when will I know that there's a particular item which is held for sale? And hence, the standard will give you certain criteria. So first of all, we need to identify between a disposal group and a discontinued operation. Remember, there can be an overlap. There may be cases where a group of assets which are held for sale is a disposal group as well as it is a component which is held for sale. So it's a discontinued operation. Or there may be a case where there is only one of them, like there is one classroom out of 10 that is intended to be sold. So that's a disposal group, but not a discontinued operation. Or there may be a discontinued operation, like there may be a segment in Ukraine that I have discontinued, or a particular business that I have abandoned, in which case that is a discontinued operation. But because I'm not holding it for sale, I cannot say it's a disposal group held for sale. So over here, there can be an MCQ where you might be tested to check whether it is a discontinued operation or a disposal group or both or none of them. Okay, so we'll probably do a question on that for a better understanding as well. Then when you look at the scope, what is covered under the standard? Well, typically PP, intangibles, goodwill, investment property, and even investments in subsidiaries, associates, and joint ventures in the SFS, which are shown using cost. So what is not covered? Well, current assets. Why? Because they are current. We cover non-current assets, and as items like inventories, which are actually current assets, will not be within the scope of this standard. And even there are certain non-current assets like a financial asset, like an investment, for example, or a deferred tax asset or a biological asset. There are separate accounting standards for this, like Ind AS 41 for a biological, Ind AS 109 for a financial asset, and Ind AS 12 for a deferred tax asset, and hence they will not be covered by Ind AS 105. Further, any form of liability like a loan, even if they are non-current, will not be covered because it is non-current assets held for sale. Now, one needs to remember that the loan can very well be a part of a disposal group. However, the write-off provisions of Ind AS 105 will not be applicable to these loans. Okay, so this is regarding discontinued operations, disposal groups, as well as non-current assets basics. Next, how do you figure out whether a particular asset or a group of assets are held for sale? So there are two important criteria. First, the asset should be available for immediate sale in the present condition. And second, sale should be highly probable, not just probable, highly probable. So there are 5 circumstances which the standard tells you to say that the sale will be highly probable. First, the appropriate level of management should be committed to the sale plan. Like the authority to sell a particular factory is with the board. So if the board is committed to the sale plan, only then can we say that this sale is highly probable. Second, over here, active process should have been initiated. You have appointed brokers, you have started searching for buyers, or a buyer should have been identified. In which case, you are not just bolte khayali pulao. You are not just thinking or contemplating. You have actually started taking action on the ground. Sale is highly probable. Third, the amount at which you want to sell the asset is reasonable considering the current market price. A slight premium is acceptable. That is the scope for negotiation. However, if you are quoting double and triple the price which is there in the market, well, it is unlikely that the sale will go through, and hence the sale is not treated as highly probable. The price should be reasonable, and it should continue to be reasonable as compared to the prevailing market price. And fourth, and the most important one, is from the date when the asset gets classified as held for sale, the sale process should be completed within a period of 12 months, subjected to certain exceptions. In all other cases, it should be completed within a period of 12 months, within a period of 1 year from the date of classification, and withdrawal from the sale plan is considered to be unlikely. So you are kind of firm on your decision and you're not in two minds. So 5 things, if they get satisfied, then we say that the sale is highly probable, appropriate level of management is committed, active process is initiated or a buyer is identified, a reasonable price is quoted as compared to the prevailing market price, the sale process likely to be completed within a period of 12 months subjected to exceptions, and the withdrawal from sale plan is unlikely. That is when we say that the sale is highly probable. However, that is one of the conditions. The other condition is the asset should be available for immediate sale in the present condition. Present condition means, for example, if this asset is subjected to renovations, like on 20th February, you decide that you want to sell. However, the broker advises that you have to renovate the flat before you kind of start marketing it. Once you start marketing, it will get over. Sale will get done within 12 months. However, the renovation is ongoing as on the balance sheet date, in which case the asset is not in the condition in which you intend to sell it, and hence the asset cannot be classified as held for sale till the time it comes in that condition, which is in which it is capable of being sold. So if the asset is subjected to renovation or refurbishment, you cannot classify it as held for sale till the time that renovation and refurbishment is completed. So over here, that is there. Further, this is regarding present condition. Now, if you are okay selling the asset in a damaged condition, that is fine. Then you can classify it as held for sale. However, if you want to renovate the asset before you sell it, then till the time renovation is completed, it cannot be classified as held for sale. In fact, even if the renovation gets completed in the post-balance sheet period, it is not an adjusting event, because as on the balance sheet date, the renovation was still ongoing, and hence you can only classify it as held for sale on the actual date when the renovation gets completed. Further, the asset should be available for immediate sale. That is, the asset should not be critical to entity's ongoing operations. Like for example, over here, you have a backlog that you intend to complete on this. There's an ongoing batch. I intend to complete that batch and only then sell the asset. However, if some buyer comes, I say that, well, I will have to first complete the batch and only then can I sell the classroom. In which case, the classroom remains critical to entity's ongoing operations and hence cannot be classified as held for sale. However, if I have arranged a backup classroom that in case a buyer comes in, I will shift the students to a nearby backup classroom, in which case the asset is no longer critical to entity's ongoing operations and hence can be classified as held for sale. So it should be available for immediate sale in the present condition. So if a buyer comes, I should be available. I should be ready to immediately sell it. However, the exception to this is sometimes there may be legal or customary delays. Legal delays would be delays like, for example, due to regulator's approval which is pending, or you have customary delays like there's a due diligence pending, or there's a tenant over there to whom you have to give a notice period. These are usual delays which are customary, and hence in such a case we can say that such delays can be ignored. So over here, if the asset is available for immediate sale but it is subjected to regulatory approval, or it is available for immediate sale but it is subjected to certain customary due diligence or notice periods, then the asset can still be classified as available for immediate sale, because these delays are legal or customary delays which can be ignored. So for you to classify something as held for sale, it has to be available in the available for immediate sale in the present condition. Second, sale should be highly probable. If both of them are satisfied, then from that date you can classify something as a non-current asset held for sale. A few special cases over here that you need to remember is abandonment or even temporary retirement is not treated as held for sale. Remember, the standard does not have the heading non-current assets retired from use. It is non-current asset held for sale. So if you decide to abandon an asset, whether temporarily or permanently, that will not be covered under Ind AS 105 provisions. You can have other standards, like for example Ind AS 36 to test for impairment if required. However, Ind AS 105 will be a very narrow and a clear focus that it has to be held for sale. Second, if there are certain events occurring in the post-balance sheet period, like a renovation getting completed or the price of an asset changing drastically in the post-balance sheet period, these are events occurring after the balance sheet date and hence will be non-adjusting, will not have impact the position as on the balance sheet date. The exception that we were saying for 1 year, usually 1 year is the time period. However, if the delay beyond 1 year is due to factors beyond the entity's control, like there was a lockdown or let us say the regulator's approval got delayed. These are factors which are beyond the management's control, and if the management still continues to be committed to the sale plan, you can still continue to classify the asset as a non-current asset held for sale. Now, sometimes in a consolidated financial statements, you might have a subsidiary which you intend to sell, and if the subsidiary is having a different business which you intend to sell, you can show that as a disposal group held for sale, and in the SFS you can show the investment in subsidiary as per Ind AS 27, which you would have recorded either at cost or at fair value as per held for sale. So these provisions even apply to investments made in the subsidiary in the SFS or even the group of assets that you intend to sell in the CFS. Now, the crucial part over here is, first we figured out what are non-current assets, what are disposal groups, what is included, what is not, then what is held for sale, when do you say that it is held for sale. But let us say if they kind of meet the criteria as held for sale, then what do you guys think? What will be the accounting impacts? Well, there will be 4 crucial impacts. First of all, on the date when they get classified as held for sale, they will be classified as a non-current asset held for sale. So they will be removed from the PP, intangibles, wherever they were shown, and they will be shown as a separate line item in the balance sheet, like non-current assets, then current assets, and then there's a separate line item for non-current assets held for sale. You'll show them as a separate line item in the balance sheet so that the reader knows that these are earlier held for use, but now they're held for sale, so you'll show them separately. Secondly, till now you have usually recorded like PP intangibles at cost less accumulated depreciation or amortization. However, now you should also compare them with the market value or fair value less cost to sell. As on the date of classification is held for sale, you will compare, let us say, the carrying value after applying all indices. So over here you will apply Ind AS 16 for depreciation, 38, 36 if there is an impairment under Ind AS 36, or even borrowing cost which was required. You will apply all standards till the date of classification and then find the carrying value as on that date after applying all Ind AS, compared with fair value less cost to sell. So you will compare the carrying value on the date of classification after applying all Ind AS and compared with the fair value less cost to sell on the date of classification and select whichever is lower. I hope you are clear. This is very similar to what you do for inventory. Like in inventory, you apply Ind AS 2, find the cost and then compare it with, let's say, in a way, NRV, net realizable value, and select whichever is lower. The logic over here is, this is an asset now which you are intending to sell, and if you are intending to sell, the amount that you are going to recover from this asset is from selling. And if your carrying value is 100 but fair value as cost to sell is 80, that means there's a 20 rupees write-off. This is also called as an impairment, though under Ind AS 105, but it is called as an impairment, which will be taken to the P&L separately. Another important difference, and this is something that you have to lock in your head very clearly, is when you look at an impairment under Ind AS 105, that can go in the P&L. However, after that, once you are under Ind AS 105, depreciation stops. Remember, if it was impairment under Ind AS 36, asset is still can be used, value in use, or can be sold. Higher of the two was the recoverable value, but the moment it is classified as held for sale, the objective is very clear. You're going to sell it. And is there any other item that you usually sell? Yes, inventory. But do you depreciate the inventory? No. Your inventory at initially as well at each balance sheet date will be compared with the cost and the NRV. In a similar way, at each balance sheet, you will keep on comparing whatever is there in your ledger with the fair value as cost to sell, and you will keep on showing this at the lower of your carrying value after applying all Ind AS which was initially there minus fair value as cost to sell, but there will be no further depreciation. I hope you understand the treatment over here is very similar to that of inventory. That is, there would be no depreciation. Secondly, at every balance sheet date, you will compare it with the fair value less cost to sell and select whichever is lower. If the fair value less cost to sell is lower, you will write off and show an impairment to be shown in the profit and loss account. So depreciation will stop from the date the asset is classified as held for sale, and the non-current asset held for sale should be a separate disclosed in the balance sheet as a separate line item. Okay, so over here we have just explained that when you say all Ind AS to be applied, you must have purchased a PP, then you did depreciation, and you arrived at an amount which was as on the date the asset is held for sale. So if it was on 30th September, you will depreciate for the 6 months as well and come to, for example, 45. So this is your carrying value after applying all Ind AS. Compare it with the fair value as cost to sell, which is 38, and hence you will show this at 38, and a loss of 7 rupees will be called as impairment loss under Ind AS 105. Or you can say this as loss on classification as held for sale under Ind AS 105 and take it to the P&L account. Are we clear with this? Okay. Now, post the classification as held for sale, depreciation will stop, and we should show this at the lower of cost on an RV and compare that at each balance sheet date. Now, is it possible that you might change a plan of sale? Yes, if you decide later, at a later date to change the plan on sale, in which case you will have to again reclassify the non-current asset held for sale back to PP. Now, if it is reclassified back to PP, then it can be sold or it can also be used, and hence the comparison over here will be with the recoverable value. Earlier, when you moved from PP to non-current asset held for sale, you compared the carrying value with the fair value as cost to sell because now you want to sell it, and hence you compared the carrying value with the fair value as cost to sell. However, now if you are reclassifying it because of the change in the plan to sell, then you will compare the carrying value after applying all Ind AS, considering there was no held for sale classification. Now, by the way, there was actually a held for sale classification. However, now we are saying that we are going to use it. So, had there been no held for sale classification, what would have been the carrying value? Had there been no held for sale classification, this would be the carrying value after depreciation, after everything. But no Ind AS 105 write-off. Compare that with the recoverable value and select whichever is lower. That will be the base for the purpose of reclassification. So if there's a change in the plan to sell, then you will record the PP at the lower of the carrying value on the date of reclassification, assuming the asset was never classified as held for sale. So had there been no Ind AS 105 classification, then what will be the revaluation? What will be the carrying value after considering depreciation and impairment, everything, but not considering 105 and the recoverable value? You will select whichever is lower, and that will be your balance. If there's a difference between this amount and the ledger balance that is there currently, that will be shown as a gain or loss on reclassification in your profit and loss account. Again, we'll do a question on this, but before that, if you look at the disposal group concept. So what do you mean by disposal group? Disposal group would mean a group of assets or liabilities which the management wants to dispose as a part of a single transaction. So when you calculate the loss in case of Ind AS 105 for the disposal group, step number 1 will be calculate the carrying value of the entire disposal group, where you will include all the assets. They may be current, they may be non-current, all the assets which the management intends to sell. So that is your carrying value of the disposal group. This can also include allocable goodwill or any other allocable item, including even the liabilities, because the management wants to transfer the entire, let's say, building along with the loans. Then the fair value as cost to sell that the buyer will quote will be for the net amount, and hence I will consider the carrying value of all individual assets or liabilities in the disposal group as per the respective Ind AS. Second, you will compare this with the fair value less cost to sell for the entire disposal group, and if the fair value less cost to sell is lower, then you will record an impairment. This is an impairment under Ind AS 105. Now, let's say this was 100, this was 80, and hence this is 20. Now, how will you allocate the 20? Like you do for Ind AS 36 cash generating unit. The first allocation will go to goodwill, if any, and excess, if any, will go to the other eligible assets. What are the eligible assets? PP, intangibles, investment property, etc. These are the items which are covered by Ind AS 105. There are other items like inventories, financial assets, deferred tax assets. There will be no loss allocation going to them because the write-off provisions don't apply to these other assets. So over here, this is very similar to the allocation of impairment loss under Ind AS 36 for a cash generating unit as well. So first you will allocate to goodwill, and excess, if any, should be allocated to PP, intangibles, investment property, etc. in the ratio of their carrying values. Again, while you do this allocation, you should ensure that the value should not go below their individual fair value less cost to sell. No part of such loss can be allocated to other assets like inventories, financial assets, etc. because these assets are not covered by Ind AS 105. One needs to be remembered that this assessment which was done on the date it was classified as held for sale will continue to happen at each balance sheet date till the time the asset is or the disposal group is actually sold. But while you move from one date, let's say 30th September, to the next date, let's say 31st March, one needs to remember that during this time frame, there can be no depreciation or amortization on PP or intangibles which have now been classified as held for sale. So the assessment would be done at each balance sheet date, and if there's a further reduction in fair value less cost to sale, same steps should be done. But one needs to remember that there will be no depreciation in the subsequent periods for PP or intangibles held as a part of the disposal group. Okay, so this is largely pertaining to the non-current assets as well as disposal groups which are held for sale. But the standard also had discontinued operations. So in case of a discontinued operation, if it is also a disposal group, then the treatment as above will apply. However, irrespective of that, in your P&L account, I will have to show the gain or loss that has happened due to this discontinued operation. Let's say there were 3 divisions, A, B, C, and during that year, we decided that we will abandon division B, or we have sold division B, or we intend to sell division B, but during the year, division B would have operated and hence there would be some revenue, expenses, etc. What I will do is, if it's a discontinued operation, I want to show my entire income statement of Schedule 3 as revenue, expenses for continuing operations. So I'll calculate my profit for continuing operations by doing a line-by-line disclosure of every item, and then at the end, just give a single line disclosure for profit before tax for discontinued operations, then less tax attributable to discontinuing operations, and then the total amount. So the idea of showing a discontinued operation is separately is that in the last year there was this operation. However, going forward this may not continue, and hence a reader might have a picture of what is the revenue, expenses that are likely to continue for a continuing operations. So a separate disclosure should be given on the face of the income statement in order to record the profit or losses from discontinued operations and their corresponding tax. The revenue or expenses on the face of income statement will only be line by line for continuing operations. Such a split on income statement is not needed if it is a mere non-current asset or a disposal group. But if it is also a discontinued operation, such an additional disclosure is given. In fact, when you study Ind AS 33 on EPS, you will be taught that you will also show a separate EPS from discontinued operations and separate EPS from continuing operations. Are we clear with this? Okay, then there are a couple of special cases. In case of a business combination, if there's a non-current asset held for sale which is acquired as a part of a business combination. So if you are a parent P acquiring a subsidiary S, and subsidiary intend to sell some non-current assets, they showed it as held for sale, parent acquires it, then Ind AS 103 will apply, and 103 says you take over assets and liabilities at fair value. However, if there is a particular item which is a non-current asset held for sale which is taken over as a part of business combination, then you will take it over at fair value less cost to sell and not just fair value. So if the acquirant intends to sell these items, you take it over at fair value less cost to sell even at the time of business combination. Further, it is possible that there is a change in the fair value less cost to sell when the asset continues to be shown as held for sale. Earlier we said that what if there was a change in the plan to sell? If there was a change in the plan to sell, you will compare the carrying value had there been no Ind AS 105 classification compared with the recoverable value, select whichever is lower. However, what if there's a change in the fair value less cost to sell, but I have not decided to change my plan on sale? Like earlier, my carrying value was 100, then I compared with the fair value cost to sell of 90, and hence I wrote off 10 rupees. Now later, let us say the fair value cost to sell increased from 90 to 95, 98. Can I reverse this? Yes. Till the time I go up to 100, I cannot go beyond 100. Are we clear with this? While doing so, you need to remember that if you are still classified as held for sale, then while reversing the impairment, you can reverse the combined impairment of Ind AS 36 as well as 105, because you are still classified as held for sale, and it is very much possible that your asset was at 100 rupees, then you record an Ind AS 36 impairment of 30 rupees, came to 70 rupees, then you recorded a 10 rupees, Ind AS 105 impairment, came to 60 rupees. Now you compared it with fair value less cost to sell, your fair value less cost to sell was actually 60 rupees, and hence it was shown later this fair value less cost to sell becomes 80 or 90. Now over here we can definitely reverse 10, but what about the other 30? That can also be reversed. Why? Because you will look at the combined write-off, that is 30 plus 10, that is equal to 40 under 36 and 105, because the asset is still classified as held for sale and hence Ind AS 36 cannot individually and separately apply. So I will say that, okay, later if the fair value increases, I can reverse it up to, let's say, 40 rupees combined. Beyond that, I cannot take it beyond 100. Earlier you were changing the plan to sell, you are moving out of Ind AS 105 back into Ind AS 16. Here you are still under Ind AS 105. So over here, you need to remember that if there is a guidance under Appendix B that sometimes it is possible that the time gap may be more than 12 months. Like we said, that regulatory approval is taking more time, or it is something where there's a lockdown, and hence the time gap is more than 12 months, which is covered by the exceptions. In such a case, the standard says that you can calculate the present value. So if you have been given sale proceeds after 18 months, you can take the discounting. But if you have been given sales proceeds at fair value, that is already at present value, you don't need to do any working. However, if a separate cost to sell is given, which is, let's say, after 18 months, is beyond 12 months, the effect of time is material, in which case you will have to do present valuation. So if the gap exceeds beyond 12 months and you are still allowed to apply Ind AS 105, then you will ensure that you can do discounting wherever required. If the cash flow is happening at a later date and you have been given the value at a later date, then you can discount it, whether it is sale proceeds or whether it is cost to sell. So over here there are a few questions. So we'll try to review the questions on this chapter. So over here, if we go to question number, for example, 4. Now in question number 4, it is not a very difficult question, but here people are usually confused between disposal group, discontinued operation. This will give you a better clarity. So over here, identify which of the following scenarios give rise to a discontinued operation or classification as disposal group as held for sale. Now MNO disposes a component, that is a division of an entity, by selling the underlying assets. The sales transaction is still incomplete as on the reporting date. So over here it is not yet sold, it is held for sale. Is it a component or a group of entity? Yes. So will it be a discontinued operation? Yes. Will it also be a disposal group or group of assets that you are intending to sell? Yes, because the sale is not yet completed, and hence this is both. PQR has ceased activities that meet the definition of a discontinued operation without selling the assets. So I have abandoned, I have ceased the activities. So is it a discontinued operation? Yes. However, do I intend to sell it? No. And hence this is not held for sale. STU ceases activities and has already completed the sale of the underlying assets at the reporting date. It ceases activities and has already completed. So over here the sale has been completed, and hence it can still be a discontinued operation. Remember, discontinued operation can be a component of an entity which is either sold or is abandoned or it is held for sale. Over here, the sale has already been completed. However, this cannot be a held for sale item because sale has already been completed as on the balance sheet date. The assets have already been sold, and hence this is not a held for sale item. VWX will sell or has sold assets that are within the scope of Ind AS 105. But does not discontinue any of its operations. So maybe there were 20 restaurants, out of which I'm selling one of them, one of the outlets, in which case this is still held for sale, which is not yet sold, but this cannot be a discontinued operation. So over here, as you can see, this is the working that you need to remember. Next you will go to question number 7. Now over here there's a change in the plan to sell. So S Limited purchased a property for 6 lakhs on 1st April 11. The useful life of the property is 15 years. So depreciation per annum will be what? 6 lakhs divided by 15 will come to 40,000. On 31st March 13, that is after 2 years, S classifies the property as held for sale, which means the carrying value after applying Ind AS would be 6 lakhs minus 80,000. Can I say 5 lakh 20,000? Okay, this is 6 lakhs minus a depreciation of 80,000. This is 5 lakh 20. The impairment testing provides an estimated recoverable amount of 4 lakh 70, which means there will be an impairment under Ind AS 36 of around 50,000, that is 5 lakh 20 minus 4 lakh 70, and hence this comes to 4 lakh 70. Can I say this is the carrying value after applying Ind AS 16 as well as Ind AS 36. The fair value as cost to sell on 31st March 13 is 4 lakh 60, which means there will be a further write-off of 10,000. This will be under Ind AS 105, and hence this will come to 4 lakh 60,000. This will be your carrying value under Ind AS 105. You compare 470 with 460, select whichever is lower, that is 470, and hence there's a 10,000 write-off. On 31st March 14, that's a year later, management changes the plan as the property no longer meets the criteria as held for sale. Management changes the plan. The recoverable amount as on 31st March 14 is 5 lakhs. calculate the value of the property at the end of 2013 and 14. So when you look at the end of 2013, you reached 4,70,000. This will be the carrying value, and after applying Ind AS, compare it with the fair value as cost to sell, and hence there will be an impairment under 105 of 10,000. So this comes down to 460. Now going forward, till the time it is classified as held for sale, actually there will be no depreciation. However, on 31st March 14, you decide to reclassify it. If you decide to reclassify it, you will compare the carrying value had there been no held for sale classification. Now, had there been no held for sale classification, you will still depreciate. You will still impair under 36, but you will not have this 10,000 write-off. So over here, you would say 4,70,000 hota minus 4,70,000 divided by the remaining 13 years into 1 year would have gone by, and hence this will be around 36,154, and your carrying value will be around 4,33,846. Had there been no held for sale classification, there would still be depreciation. There would just not be that 10,000 write-off, but there would still be depreciation. Compare that with the recoverable value, which is 5 lakhs, and hence you will select whichever is lower, which is 4,33,000. Now in your ledger, you are showing the asset at 4,60,000. There would have been no depreciation. Even 31st March 14, there should be 4,60,000. Now we have to take it down to 433. So 460 minus 433, 846. It will come to 26,154. This will be shown as a loss on reclassification. So if I look at this, carrying value as on 31st March 14, had there been no held for sale classification, 433. Compared with the recoverable amount, which means the ledger balance should be 433. Compared with the actual balance of 460, and hence there will be 26,154 loss on reclassification of the property account debit to property. Therefore, the PP will appear at 433,846. Now, if you see the institute solution, it ends over here because it focuses on the narrow aspect of what will happen if there's a change in the plan to sell and stops over there. However, if you assume that there was an improvement in service potential, in which case there can also be a reversal of impairment under Ind AS 36, as we have explained over here, in case you have to take that separately. Though institute has not done that, and they've just focused on the change on the plan to sell. They've not said that there is any improvement in service potential, and hence the solution ends without considering a possible further reversal of impairment under Ind AS 36. Okay, then you look at question number 8. Ajay, if you had to see the impairment under Ind AS 36 reversal, the above extra workings will help you in that. Question number 8 is one of the important questions where you have been told at the end to assess whether the manufacturing unit can be classified as held for sale and reasons thereof. Second, the measurement of the manufacturing unit on the date of classification as held for sale. And third, measurement of manufacturing unit at the end of the year. So if you review this, on 1st of June, the entity X merely plans to sell a group of assets which is classified as a disposal group. So it's not a discontinued operation, it is a disposal group. On 31st July 11, the board of directors approves and becomes committed. This is rated when they approve and become committed to the plan to sell the manufacturing unit by entering into a firm purchase commitment with entity Y. So over here on 31st July, the management is committed. A firm purchase commitment with Y is entered. So a buyer is identified. So the price in any case would be reasonable because the buyer is identified. Fourth, you have to see whether the sale is likely to be getting completed within 12 months. However, since a manufacturing unit is regulated, the approval from the regulator is needed. The approval from the regulator is customary and is highly probable to be received by 30th November. So should I wait till 30th November to classify it as held for sale? No. Why? Because the delay from 31st July to 30th November is customary, it is legal, and hence as per the exceptions it can be ignored. The asset can be considered to be available for immediate sale from 31st July onwards, irrespective of that delay due to regulator. And the sale is expected to be completed by 31st March 12. So from 31st July, this is within 12 months. This is hardly around 8-9 months, and hence this is within 12 months. Entity X follows the December year end. The assets and liabilities are given to you. Over here, you'll have carrying value on 31st December 10 and then 31st July 11. Now, you have to find the carrying value on the date it is classified as held for sale. So, the first point says, assess whether the manufacturing unit can be classified as held for sale. Yes, it is available for immediate sale. In the present condition, there is nothing requirement for renovation. And secondly, the sale seems to be highly probable, and hence, it will be classified as held for sale from 31st July 11. And hence, on this date, you will compare the carrying value. On this date, you will compare the carrying value goodwill, plant, building, debtors, inventory, creditors, loans, all said and done, your carrying value is 2600. 31st December 10 ko kuch hoga, but it was not classified as held for sale on that date. Now the fair value of the manufacturing unit on 31st December 10 was 2000. However, I'll again repeat, it was not classified as held for sale, and hence there will be no write-off on 31st December 10. And as on 31st July, this is 1850. Okay, the cost to sell is 100 on both the dates, which means if I go on 31st July 2011, 1850 minus 100 will come to 1750. You will compare 2600 and 1750 comes to what? 850. There's an impairment of 850, and this 850 will be allocated first to goodwill. So out of this 850, can I say 500 will first go to goodwill? Acha, remaining will go where? To the eligible assets. Plant and building. Remember, debtors, inventory, creditors, loan are not covered by Ind AS 105. And hence, out of this, 500 goes to goodwill. The remaining 350 is attributable to plant, that is into 900 upon 2750. And remaining 350 is attributable 1850 upon 2750. So this is 350 into 900 upon 2750. This is 115. 350 into 1850 upon 2750, 235. And hence over here there will be a write-off of 115 and 235, and hence the revised balances would be 0 for goodwill, maybe 785 for your plant, 1850 minus 235, that is 1615 for your building, and everything else remains the same. And hence if you do this, your total, everything else remaining the same, 1050, 400, 250 and 1850. This comes to 1750. Are we clear with this? So over here they are asking you to find the measurement of the unit as on the date of classification held for sale. We'll say for the entire unit this will be measured, instead of 2600 it will be measured at 1750. The difference of around 850 will be transferred to the P&L. Second effect, going against goodwill, 500. So your entry will be impairment loss under Ind AS 105, 850 to goodwill, 500 to plant and machinery, 115 to building, 235, and thereby your entire asset will come down to 1750. Acha, आगे देखते हैं. The disposal group is not sold even at the year end, that is 31st December 11. The fair value as on 31st December 11 is lower than the carrying value of the disposal group as on that date, but they have not told you how much lower. So our answer will be theory, which means what you will do is you will find whatever is the further impairment loss, and that will be allocated to the plant and the building in the ratio of 785 is to 1615. This is to be allocated to the building and the plant in the ratio of 785 is to 1615, because goodwill is now already 0. So whatever is the further loss will be taken up by the building as well as the plant only. Now based on that, you have question number 9, which is a much more calculative question. So over here, CK prepares finance statements as per Ind AS for 30th June. No, this is something else. We'll first do question number 10. It's a little more calculative as a question. So following is the extract of the consolidated statements of A for the year ended on 31st March 11. Okay, so you've been given an extract for all of these items, and this is 2250 after all assets, all liabilities. On 15 September 11, NTTA decides to sell the business. It may be noted that the business meets the condition of disposal group classified as held for sale on that date in accordance with 105. So unlike the last question where you have to figure out what was the date, that was 31st July, here it has been given to you. This is 15 September. However, it does not meet the conditions to be shown as a discontinued operation. Fair enough, in accordance with the standard. The disposal group is stated at the following amounts immediately prior to the reclassification. So you have this entire balance coming to 2160, everything is in 1000. This is on 15 September. Remember, the balance on 31st March is irrelevant because the classification as held for sale is coming on 15 September. Okay. NTDA proposes to sell the disposal group for 1900,000 if I take everything in thousands, and it estimates the cost to sell will be 70 in 1000. The cost consists of professional fee to be paid to the lawyers and accountants, which means can I say the fair value minus cost to sell will be 1900 minus 70. Can I say this is 1830? At 31st March 12, there has been no change in the plan to sell the disposal group, and NTDA still expects to sell it within 1 year of the initial classification. Okay, so that's still classified as held for sale. You are now on 31st March 12, but thankfully you have been given data now. Mr. X, who is an accountant of entity A, remeasured the following assets and liabilities in accordance with the respective standards as on 31st March 12. Okay, so over here, this is 31st March 12 data, but before that, I need to compare this 2160 with 1830, and there is 2160 minus 1830. Can I say there is a 330 impairment? Now, if this an impairment of 330 will first be allocated to goodwill, so 200 over here is directly knocked off against goodwill, and hence the remaining, I think 130 will be attributed between intangible assets and property, plant and equipment in the ratio of 930 is to 1050. So over here we'll have 130 into 130 into 930 upon what is this? 1950. 930 upon 1950. So this is 130 into 930 upon 1950. This is 62 rupees. And 130 into 195, sorry, not 1020 upon 1950. So this is 130 into 1020 upon 1950. So this is 68. Okay, and after that you can see your goodwill becomes 0. Intangibles become what? I think 868. This is 360. This is 1020 minus 68. This is 952. And then this is 250, 520, minus 870 and minus 250. And hence if I total all of this, 868, 360, 952, 250, 520, minus 870, minus 250, and hence this is 1830. So this is the position on 15 September. Now on 31st March, they have given you data regarding financial assets, deferred tax assets, current liabilities and non-current liabilities, but they have not given you data regarding goodwill, intangibles and PP. But can I say they will remain the same? Yes sir. Will there be any depreciation? No. So over here to this you will add intangibles, to this you will add PP. So your intangibles were I think 868, this will continue as it is, and your PP would be 952, and hence this is 868 plus 952 plus 410 plus 230 plus 400 minus 900 minus 250. This comes to what? 1710. So this is your carrying value. This is 1710. On 31st March, you have been told that the disposal group has not been trading well and the fair value as cost to sell has fallen to 16. This is directly given to you, 1650. So you will compare FV less CTS as 1650, 1710 minus 1650. This comes to 60. And this will be impairment. And this 60 will be attributable to the intangible assets as well as to PP in the ratio of 60 is to 868 upon what is that? 868 and 952, that is 1820, and 60 into 952 upon 1820. Are we clear with this? This is around 29 and around 31. So if you look at the final values over here, you will have minus 29 minus approximately 31, and that's about it. You will end up to 1650, which is the revised carrying value. There will be no impairment during those 3 months. Okay, so question 10 is a little more calculation as compared to question number 8, which had both calculations as well as your identification on whether it is held for sale, and if yes, from which date. Now question number 9 is also an important question. So basically 8, 9, 10 in my opinion, 7, 8, 9, 10 are the most important questions from this chapter. So we'll go to question number 9. CK prepares CFS as on Ind AS for the quarter ended 30th June. During the 3 months ended on 30th June 18, the following events occurred. So this is during the quarter. On 1st April 18, that is at the start of the quarter, the company has decided to sell one of its divisions as a going concern, following a recent change in its geographical focus. So is it deciding to sell one of its divisions? Yes, and hence this can be taken as a discontinued operation, and this can also be disposal group because you are intending to sell it. The proposed sale would involve the buyer acquiring the non-monetary assets, including goodwill, of the division, with the company collecting any outstanding trade receivables relating to the division and settling any current liabilities. So when I'm planning to transfer, I'm not planning to transfer the trade receivables and current liabilities. I'm planning to collect it myself and pay it myself. But the non-monetary items like goodwill and other non-monetary items, I'm planning to transfer. Okay, on 1st April 18, the carrying amount of the assets of the division were purchase goodwill 60, PP 20 lakhs and inventory is 10 lakhs. So if I total this will come to around 30 lakh, 60,000. This will be your total carrying value on 1st April 2018. From 1st April 18, the company has started to actively market the division and has received number of serious inquiries, which means the active process is initiated. On 1st April 18, the directors estimated that they would receive 32 lakhs from the sale of the division. So your fair value less cost to sell seems to be 32 lakhs, which means is there any impairment? No. Remember, it is not necessary if there is an impairment. If there is an impairment, yes, you will allocate first to goodwill and then to, let's say, BP. But there is no impairment over here. Since 1st April 18, the market condition has only improved. And as on 1st August 18, the company received and accepted a firm offer to purchase the division for 33 lakhs. Okay, this is on 1st August. The sale is expected to be completed by 30th September and 33 lakhs can be assumed to be a reasonable estimate of the value of the division on 30th June. So if I need to figure out what is the position on 30th June, fair value as cost to sell on this date was 33 lakhs. During the period 1st April to 30th June, inventories of the division costing 8 lakhs were sold for 12 lakhs. So there was a profit of 4 lakhs. During these 3 months on sale of these inventories, remember this profit will be shown separately because this is a discontinued operation and hence this 4 lakhs of profit will be shown as a separate line item. I will not show sales of 12 lakhs, I will not show COGS of 8 lakhs, I will show the profit of 8 lakhs separately because this is a discontinued operation as well. As at 30th June, the total cost of the inventories of the division was 9 lakhs. Now a student might say that initially the inventories were 10 lakhs. 8 lakhs worth of inventory is sold, so ideally 2 lakhs bachne chahiye. However, it is possible that I can even continue to purchase inventories as they get sold, and hence if the inventories are 9 lakhs, well, they are 9 lakhs. All of these inventories have an estimated NRV in excess of their cost, so there is no write-off. The company has approached you to suggest how the proposed sale will be reported in the interim statements for the quarter ended 30th June, given relevant explanations. Now, if I look at 30th June, the carrying value of this disposal group will be, goodwill continues to be at 60. PP, what do you guys think? 20 lakhs यहाँ पे दिख रहा है. This was on 1st April and the remaining useful life is 2 years. Think and tell me, should you depreciate? Yes, sir, there was a hidden adjustment. No, you should not depreciate because on 1st April 18, you are classifying this as held for sale, and the moment this is classified as held for sale, there will be no further depreciation, and hence this will continue. You have to resist the temptation to depreciate this because it is now classified as held for sale. Plus inventory is, I think, 9 lakhs, and hence if I total up, this is what? 2960 probably. And if you compare this with the fair value as cost to sell, in this paragraph you have been told that on 30th June it is assumed that the fair value as cost to sell will be around 33 lakhs, and hence here also there is no impairment. So over here you will definitely show this as a separate non-current asset held for sale. In your balance sheet there will be current assets, non-current assets, and then non-current asset held for sale appearing at around 29 lakh 60,000. There will be no further impairment, and in your P&L account as a part of your workings you will show profit from discontinued operations of around 4 lakhs. As you can see over here, there is no impairment, and being a discontinued operation, profit of 4 lakhs can be disclosed separately in the income statement. Okay, 10 is done. Other than that, you have 11, which is on a special case, which is pertaining to business combination only, not very important. 12, 13, 13, if you go to see, there is a case where on February 20th, 11, Entity X is committed to the following: to sell a property after completion of renovations to increase its value prior to selling it. The renovations are expected to be completed within a short span of 2 months, which means from 20th April, they will get completed on 30th April 11. And hence, this cannot be classified as held for sale because it is not in the present condition of sale. And hence, this cannot be classified as held for sale. To sell a commercial building to a buyer after the occupant vacates the building. The time required for vacating the building is usual and customary, and the sale of such property, the entity considers sale to be highly probable. Now, this can be classified as held for sale because even though there is a notice period involved, that is considered to be customary and hence that can be ignored. So over here in point A, you will say that it is cannot be classified as held for sale, but in point B, you can say should be classified as held for sale. Okay. Next you have question number 14. Again in question number 14, you can review this, but यहाँ पे it is just that the time gap was more than 12 months. If the time gap was more than 12 months, then you will have to do present valuation. So over here, you had a board had approved a plan to sell division on 30th September. The sale is expected to be completed after 1 year, but it qualifies to be held for sale under the appendix. So it is under the exceptions. Cost to sell the division is 10 crores to be incurred in March 13. Today you are sitting on which date? 30th September 11, which means, can I say this 10 crores is going to be incurred after 18 months? Aja, the fair value of the division, remember the fair value is the present value after considering everything, is 400 on 30th September and also on 31st March. You don't have to separately discount this because it is already fair value. Aja, the carrying value is 500 crores. How should the division be measured under Ind AS 105 on the following dates? Well, you will compare the carrying value with the fair value less cost to sell. So your fair value less present value of CTS. You will find PV of CTS. So over here this will be 400 minus. You will take the discounting factor of 10% for 1 year and then for 1.5 years. So this is 10 into 0.867. So this is 8.67. And hence 400 minus 8.67 will come to around 391.33 compared with 500, and hence there is a write-off of around 108.67. So as you can see over there 391.33, and hence on 30th September there will be a write-off to the extent of 108.67. Now later, 1 year later or 6 months later, fair value minus present value of cost to sell will now be 400 minus, let's say, 10 into 0.909, and hence this is 9.09, and hence this is 400 into 0.909, 400 minus 10 into 0.909, so this is 400 minus 9.09, this is 390.91. So there is a reduction, if I go to see, of 391.33, and this is due to unwinding of discount. So there is not further impairment, it is the discount that was 10 rupees of cost to sell coming to around 8.67 and now going to 9.09. So this will be taken as unwinding of discount, 390.91, and there will be a 0.42 unwinding of discount. Now the last question, this was question number 14. From your exam paper, there could have been an alternative treatment over here, but Institute has done this directly. So following details are there for Hydra on 31st March. You have the carrying amount at the reporting date before the classification is held for sale, and carrying amount is remeasured immediately before the classification is held for sale. So there is goodwill, PP, building, investment in equity shares, inventory, all of this is given. You will have to look at this column because this is on the date it is classified as held for sale. Hydra estimates that the fair value less cost to sell is 65 lakhs. Okay. State as per applicable Ind AS how and at what amount the loss should be recognized as disposal group as per held for sale classification. In this case, if I total up everything, 750, 20 lakhs, 2850, 11 lakhs and 750. So if I go to see, this is I think 74 lakh 50. You compare this with 65 lakhs and hence the difference comes to I think 9 lakh 50. So write off is 9 lakh 50, out of which first you will adjust against goodwill 7 lakh 50. This is clear. Now the remaining 2 lakhs, ideally this is a problem in my opinion over here. They have said that PP is carried at revalued amounts. Now if indeed PP is carried at revalued amounts, then PP will say that I'm already at the fair value and hence I will not bear any further loss, and hence if you have to take the 2 lakhs, you will have to allocate it to building only. However, Institute probably has said maybe they have allocated it to both. So maybe they have assumed that the revaluation must have been done at sufficient intervals, and currently 20 lakhs does not necessarily represent the fair value as on the date of reclassification. It is maybe revalued sometime back minus the carrying value, and hence as per ICI solutions what they have done is the 2 lakhs that remains was allocated to plant as 20 by 48.5 and to building as 2 lakhs into 28.5 upon 48.5, and that is what Institute has done. So this is 7 lakh 50, some part is going to PP, some part is going to, let us say, the building as well, though an alternative treatment and solution is possible and maybe even appropriate if you assume that 20 lakhs is a fair value, then plant will not bear it. then building will have to bear it. But institute has not done that, so we will ignore it. So this kind of takes care of the entire Ind AS 105 along with the important questions. I hope you have got a fairly good clarity of this topic. I'll see you soon with another topic. If you do like this video, please like, share, and even share it with your friends if you think it helps. Subscribe to our channel, and it means a lot to us if you kind of show that love. Okay, so I'll see you soon with another video. Till then, bye bye, take care, and keep studying.